Well, here we are at the UMass Club high above the city skyline in Boston, and it's exciting. I love being here.
Money Matters has made it.
Absolutely. So let's start things off with trending topics. What do you say?
Let it rip.
All right. Number one, the bank fees. I've noticed, Dave, that these are up all over the place. What's going on with that?
It's the theme that you and I keep talking about each and every week on this show, the unintended consequences of government getting involved in business. The Dodd-Frank bill, right? I mean, we said it on this show that obviously if banks are going to be charged more and have more legal fees, they're going to pass it on to the consumer. And that's what's going on. I mean, the free checking accounts that we used to see years ago, I think there's only 20% of the banks right now doing that. ATM fees, I think on average, are $2.50 for a convenience fee. Doesn't feel very convenient for me. The banks are passing it on to the consumer. It was as easy to see. I mean, we said it here on this show, Chuck.
And so many people have so much to worry about in their normal lives that they don't usually look at these fees and get too worked up about it because it's 10 cents here, a dollar there, and in the grand scheme of things, it adds up.
Well, you know what really adds up is the overdraft fees. You know, and a lot of times, you know, what banks will allow you to do is to use that card, you know, for a debit card and get you into Debitville and end up hitting you with a $30 or $40 overdraft. By the way, that's like one of the top money makers for banks. So,
so you really have to look at your account and not neglect it. I think that's important. Okay, so let's move on. Recession recovery and the election. Are we really talking about a recovery from the recession as we're talking about possibly going into another recession, Dave?
Yeah, I think what's going on, I mean, this is said that this is the worst recovery of the last 10 recessions, and we've seen that with jobless numbers, with the GDP continuing to be ratcheted down, meaning what the economy is producing. We spoke to Scott Harshbarger last week, and he talked about this being more of an election of popularity than an election of issues. And again, you've got an economy that is sputtering, but yet the polls are still this close.
And you wonder if the medicine is actually worse than the disease itself, and what the government has been doing to try to get us out of this recession. Is it causing us more harm than good?
Yeah, I think at the end of the day that's exactly what's going on, Chuck, that the medicine, meaning the Fed, you know, we used to take one pill to make us feel better. Now we need the QE3. We need 3, and that's going to continue. Congress needs to get its act in gear.
So, Dave, here's the big question. Halloween is coming up. What are you dressing up as?
I'm going to dress up as a host of Money Matters. It's flying off the shelves, I hear.
Well, it's a very popular costume. Everybody is getting excited. So if you see 2 young kids coming up to your door, ring the doorbell, and they're dressed like us, make sure you put a lot of candy into their pillowcase there, because I think it's the costume that's going to win all the blue ribbons.
Yeah, you know what, Chuck? I think what's going on right now is there are 170 million people planning on what they're going to wear for Halloween, and that's a good thing. Get our minds off of what's going on politically and go out there and actually start spending some money for the economy. It's our way of having a stimulus without the Fed.
And then pretty soon I'm going to be asking you about Thanksgiving and Christmas and New Year's, and it's just going to be flying. The year's going by real fast, Dave, huh?
Agreed.
All right, well, we'll take a short break, and we'll be back in just a minute with more Money Matters Boston.
Peace of mind. Everyone wants it. Few people find it in today's uncertain economic times. Ross Mortgage understands that finding the right mortgage can be stressful. That's why we created programs like Custom Closing to save you time and give you the peace of mind so you can concentrate on the things that matter the most to you and your family. We'll walk you through every step to assure satisfaction. You can be confident that we'll close your loan on time, every time, guaranteed.
Ross Mortgage. Allow us to show you the way home.
This segment of Money Matters Boston is brought to you by Flagship Wealth Management.
Welcome back to Money Matters. It is my pleasure to introduce Mark Giovanniello, Portfolio Manager and CIO of Copeland Capital. Hey, Mark, welcome aboard.
Thanks. Great to be here, Dave.
I understand you actually flew in from Philadelphia just to be on this show today?
I did. That's how big it's become. We're hearing about you down south.
Down south. Well, we appreciate you coming on board. You've got to tell us the secret. I mean, a year ago, your fund had 30 million, and now it's over 330 million. What's the secret?
It's been a great year, and it's been a tough year for equity fund flows. We certainly launched into a tough environment. I think we're offering 2 things that has really struck a chord in the marketplace. One is dividends. With the current yields you can get right now in bonds, Treasury yields being at 1.5%, there's a big surge for yield. But we offer it in a different flavor. We're focused on companies that raise their dividends every single year. So that's all our firm is focused on. At the same time, we've offered a mutual fund, our Copeland Risk Managed Dividend Growth Fund.
Now wait, let's
which
take
is
a step
big
back.
mouthful.
That's a lot to take in, right?
And that's
Risk Managed Dividend Growth Fund.
Correct.
Explain.
The idea is to provide risk management, not just by the lower risk dividend growth stocks that we own, but at the same time to be a manager who's willing to step aside if market volatility increases and prices decline, and there seems to be a risk of further deterioration. And so we're willing to raise cash in our strategy. Yeah. So combining that, the dividends, the dividend growth strategy, with the willingness to step aside and not ride the market down has struck a chord. I think investors have been burned twice in the last 10 years, 2002, 2008, these major crashes in the market. And our portfolio is designed to step aside when our signals tell us that there's a substantial risk of a major market decline.
Individual investors are going to the bond side of the market, not stock, but you're starting to see more Main Street going to stock. To me, that's a counterindicator. To me, it's almost like maybe the market is over heavy. Maybe the market is overextended. What is your thought on that?
Sure, retail investors are certainly have a poor track record of timing the market. And now after the market's bounced 25–30% over the past year, and as well it's more than doubled since the market low, a lot of people are saying, okay, maybe I should participate, but there's a great nervousness because we've seen those two crashes and we've seen this extremely volatile market over the past few years. So the timing of the retail investor is bad, and we're starting to see some interest from retail investors in getting back in the market. And I think what we offer is a solution where we won't just ride down the next crash. You know, who knows if it happens, and we don't profess to have a crystal ball to say it will or will not happen. Mm-hmm. We just focus all of our efforts into finding the best dividend growth stocks to populate the portfolio.
It takes emotions out.
It does. It's emotionless, and that's the key. It's very difficult, even as portfolio managers and professionals, in trying to predict which way the market's going to go in the future. And we don't, as much as we are willing to go to cash, we don't try to do that. We follow the price trends and the signals. When they tell us to act, we act, no questions asked.
What is the portfolio yield? You talked about a 10-year Treasury yielding 1.617. In my opinion, a terrible place to get yield, but to put your money at this point. What does your portfolio yield? What is it giving off in interest?
Sure, the underlying stocks in our strategies, including the risk managed mutual fund, yield about 3%, to the high 2s to 3%. So you do get a premium over the market, and you have a significant premium over the options in the bond market, and particularly treasuries.
Okay.
What it doesn't do is chase after yield alone. And I think one of the big risks in the bond market is a reversal of interest rates, maybe higher inflation. And as a result, the high-yielding stocks out there that many investors flock to in times like these, the Verizons, AT&Ts of the world, the high-yielding Pfizers, Johnson & Johnsons of the world, they attract a lot of capital, but when interest rates rise, they tend to act more like bonds. Mm-hmm. The companies we focus on are those with, we believe, double-digit 10–15% dividend growth prospects. So you combine that 3% yield with 10–15% dividend growth, it's a great hedge against the likelihood or the potential of rising interest rates down the road and upside participation in a stock market when it's rising.
We're getting to the end, and we're always trying to add value to our viewers in the market. I know that Copeland has come out with a piece that actually goes over what would happen with dividends, in the rise in the taxation, with the fiscal cliff, tax-mageddon coming down the horizon. You think you could offer that to our viewers?
Sure. We'd love to share that with you. It's posted to our website, and love to have it up on yours. What we looked at was the performance of dividend strategies when there are changes in tax rates, because that's a big fear. The U.S. fiscal cliff next year certainly has a component to it where dividend tax rates could go from 15% now for the highest tax bracket up towards 43%. When you include the extra tax and the healthcare reform. Mm-hmm. That's a big jump. And what we did is we went back to both the last two big changes in tax rates. First, in the early 90s, we had a jump in tax rates from the high 20s to the high 30s. Mm-hmm. And what we've found is that there's very little correlation between the performance of dividend stocks, and especially dividend growth stocks, and the change in tax rates. What tends to happen, the dividend stocks tend to act more in line with where we are in the economic cycle. If you think of the early 90s when the tax rates rose, that tends to have a negative impact. Think the fiscal cliff next year. What kind of macro impact will that have? That tends to hurt the market overall, hurt the economy.
Consumers, right? There's less money in our pockets.
Investors then flock to more defensive stocks. So dividend stocks actually often do better in a period when tax rates rise because of the harm on the market and on the economy. If you think of the early 2000s, the Bush tax cut down to the current 15% dividend tax rate. That was actually in 2003 one of the best years for high beta, high risk stocks, and dividend stocks were left behind. So our paper looked closely at that and found very little correlation, if not counter correlation.
I think our viewers are going to get a ton of value in it. I appreciate you coming out all the way from Philadelphia to share the Copeland story. 30 million to 330. Will you come back when it's at a billion?
We absolutely will.
Excellent.
Be my
Thanks again
pleasure.
for coming out.
Thanks, Dave.
Mark Giovanniello, Portfolio Manager and CIO of Copeland Capital. Stay tuned, there's more Money Matters coming your way.
It starts with a goal. You know where you want to be in 20, 30 years. But how do you get there? Flagship Wealth Management can be your compass, guiding you through these challenging times, steering all your investments to the same destination. We are an independent advisory firm backed by the largest independent broker-dealer in the country. You can feel safe knowing our advisors have all the knowledge and tools to guide you to your goals. Flagship Wealth Management, helping you navigate your way to financial freedom.
This segment of Money Matters Boston is brought to you by SHP Financial.
Welcome back. Joining me from Fidelity Investments is John Sweeney. John, thanks for joining me on the Money Matters program. We've been talking quite a bit about fiscal cliff over the last handful of shows. What are you telling people?
Right. We get a lot of questions about fiscal cliff and what does that mean and how should investors react. So the important thing that we try and maintain with our clients is to focus on the long term. What are the goals that you're trying to achieve? Are you trying to save for retirement? Are you in retirement and you're trying to manage your distributions and make sure that you have enough income to sustain the retirement lifestyle that you'd like? Those are the questions that we get. And what we try and do is help people understand that elections happen every 4 years. There are always crises around the world, whether they're in Europe or other parts of the world. And we should maintain focus on the investments that we have in our portfolio and make sure that they're well structured. So when we have retirement conversations with our clients, for example, we want to make sure that their portfolios are structured to be diversified between equities, bonds, and cash, and understand the role that each of those three asset classes play in the construction of their portfolio.
Now, a lot of people are watching who probably don't have any professional help whatsoever, and they see what's going on in the news, they see the political headlines, and they've got to be scared out of their minds. I mean, is this any more of a reactionary period, do you feel, with the people that use your services? Are people freaking out?
No. And part of the dialogue we'd like to have with customers is to give them the tools and the resources and the confidence to make the right decisions. So when people call us and they say, I'm concerned about potential outcome of the fiscal cliff, we try and, again, bring them back to the goals that they're trying to achieve. And when you have a well-structured plan and you're confident in that plan, you feel much more comfortable about weathering whatever storms may come in the future.
Now, I think we've talked a lot about the show about the most hated rally, which was this year, where the market perceivably does really well. But is there some, false pretense associated with that? I mean, what do you think? I mean, are people lulled into this false sense of security with the big rally that we've had over the summer?
What's important is that as you think about the rally, the first quarter was quite strong, the second quarter fell a bit, and the third quarter has been very positive. So what you've seen is a period where we've been up almost 15% year to date, but people have missed out on it because they've been concerned. They've been concerned about the upcoming election. They've been concerned about Europe. And so over the past couple of years, we've seen a significant shift of flows into bond funds. And so people have really missed out on that equity rally. So what's important, again, to recall is to think about how I want to use equities and to maintain a disciplined approach to how you structure your investments. Then you don't get so worked up about the short-term vagaries of the market.
What do you feel is one of the most key pieces of economic data to track as far as a general pulse of the economy and how we're doing? Is it unemployment? Is it a political thing? Like, what do you think is the one area that you watch and go, that's quite important?
Corporate earnings. Corporate earnings really drive results, and so if you're investing in companies that continue to grow their earnings, they will tend to do well regardless of what part of the globe they operate in, regardless of what political or economic climate they're in.
Before you and I got onto the set here, we were talking about really the kitchen table of conversations that people will have with their advisor or even with their spouses about how much income to take.
The conversation really has to start with, you want to make sure that your burn rate is less than your earn rate.
Right.
So we hear customers come in and they say, I'd like to maintain my current lifestyle. We have to take a look at that lifestyle and make sure that that's one that can be sustained with the amount of income you can produce from your portfolio. So however you construct that income stream in retirement, we want to make sure that your expenses don't exceed the amount that your portfolio can sustain. So we go through a process where we look at the essential expenses that clients have, healthcare, food, shelter, and we make sure that you cover those essential expenses with as certain an income stream as possible, Social Security, pension benefits, or fixed payment streams. Then you get to travel, lifestyle choices that you make. Those can be covered by more variable income streams.
Okay, I was going to say, how does, have you been worried about inflation? I think everything going on in Washington, is that something that you feel could be a problem down the road, and even hyperinflation, I've heard? Well, inflation is always something that you want to make sure you factor into planning. So you want to factor in longevity. So most customers don't think about planning to their mid-90s, but statistically, there's a 25% chance that 1/2 of a couple will live to age 92. So some of those people are going to live to beyond age 92. So you want to be planning for a fairly long period of time. Throughout that time period, you've got a 30-year period where we've seen historically that inflation has continued to climb. So you want to make sure that you do have enough equities in your portfolio to outpace inflation. Fixed income alone historically hasn't outpaced inflation, and therefore the equity component is something that retirees often are unwilling to accept the risk or neglect to construct inside their portfolios. Well, John, thank you so much for coming on the program. John Sweeney from Fidelity Investments. Let's take a short break and we'll be right back with more great financial talk.
Are your investments in CDs and money markets returning less than you expected? There is a better way. Get a structured settlement transfer from SHP Financial and start earning better rates right away. Learn more by calling SHP Financial at 508-591-5070, and we will send you a free buyer's guide on this exclusive opportunity. Call now and you will be added to our email newsletter, where actual cases on the market currently are sent to you instantly. SHP Financial, 508-591-5070.
This segment of Money Matters Boston is brought to you by Ross Mortgage Company.
Well, life insurance has played an important role in just about everybody's personal financial situation. And joining me to talk about some of the advantages of life insurance is Dave Nichols from Frontier Advisory Group. Dave, thanks for joining me on the program.
Chuck, thanks for having me.
Well, life insurance is an important part of people's personal financial situations. We never want to have to use it, but it's important to have. If something horrendous goes wrong, it's going to protect the family, so we're always told to have it. But let's talk about life insurance being used in other more non-traditional ideas. And I know you do a lot with life insurance when it comes to income planning and retirement planning. How does that work?
Sure. Well, you're absolutely right, Chuck. The death benefit associated with life insurance is so critical, but many people are less aware that the living benefits associated with some types of life contracts are truly beneficial as well.
Now, I know way back in the day, life insurance had a bad reputation and was oftentimes very confusing to understand, sold improperly, and it has left a trail of dismay, I guess, in the public's eye. But just like any industry or any product, it has evolved to a more comforting and modern style to it, and that's what you're referring to now, right?
It is, Chuck, yeah, and that is very true. Life insurance contracts these days are much more understandable. Everything is spelled out. Oftentimes in the past, a whole life contract had certain aspects that you just really couldn't decipher. And it was very difficult for a person to go through that and truly understand, how is this working internally? What am I doing here inside this contract? Yes, I'm getting a death benefit, but this cash accumulation, I'm unclear about how that works. And the evolution these days has come to a point where there's something called fixed indexed universal life, and it's much more transparent.
Now, somebody that has a 401k or an IRA, they're building up these accounts so that they can draw an income off of it in the future. But the great variable is if I have $500,000, we don't know what the income tax rate is going to be, say 15, 20 years down the line. When it comes to having that same amount in a life insurance policy, is what you're telling me true, that you can make withdrawals there like you would in a 401k, yet it's going to be tax-free?
That's exactly right, Chuck. So you have much more predictability than you would have with your 401. The other concern that people have is, well, you know, we've seen what the market's done in the past with these sharp declines in a short period of time. The beauty of a properly structured indexed universal life is such that it protects you from the downside. You have a contractual guarantee that if the market goes down, I'm not going to participate in that. And when we have those upswings and we participate and the money grows, I'm going to access those gains without taxes. Very different than your qualified plan.
And the concept right there isn't anything new to people who are familiar with, say, an indexed annuity kind of contract where they get the upside of the market without the downside risk, and then they have the ability to make withdrawals. Why aren't all advisors talking about this with their clients? What's the big question mark?
Sure. Well, you know, it really is starting to grow. It is becoming more popular and more talked about. But yeah, it isn't as conventional as your mutual fund strategies, or in fact the annuity that you mentioned. It's becoming more well known, but at this point, not as much as it should be. You know, you truly have to structure this properly. You need to set it up properly, because if you don't, those tax advantages that you just talked about, that you mentioned, those go away. So it is important that you deal with an expert, someone that's done it many times before, because the tax advantage, you know, is truly at the top of the list with respect to putting a plan like this in place. So it is important that you do it properly.
Who would be somebody that you think in your professional experience would benefit from something like this?
Sure. Well, just about everybody would benefit, Chuck. Once you get north of probably 68 or 70 years of age, it does become a little more challenging. There really isn't quite the same amount of time that you would need to properly put this together and have it really benefit you down the road. So I would say anyone south of 69, 70 years of age would be a proper fit. It's a cornerstone of my personal financial planning, and oftentimes when I sit down with clients, you know, I'll show them the performance that I've had over the years, show them my contract, and explain to them, this is what it's meant to me over the years. We've had a horrific past 10 years in the market. So to average 6.5%, 7% throughout that time frame, not experience the losses, and know that I'll be able to have access to those gains without taxes. And then, of course, going back to the beginning of our conversation, the death benefit's always there.
Well, Dave Nichols from Frontier Advisory Group, thank you for joining me on the Money Matters Boston program. We're going to take a short break, and we're going to be right back with more great money talk in just a minute.
Peace of mind. Everyone wants it. Few people find it in today's uncertain economic times. Ross Mortgage understands that finding the right mortgage can be stressful. That's why we created programs like Custom Closing to save you time and give you the peace of mind so you can concentrate on the things that matter the most to you and your family. We'll walk you through every step to assure satisfaction. You can be confident that we'll close your loan on time, every time, guaranteed.
Ross Mortgage. Allow us to show you the way home.
It starts with a goal. You know where you want to be in 20, 30 years. But how do you get there? Flagship Wealth Management can be your compass, guiding you through these challenging times, steering all your investments to the same destination. We are an independent advisory firm backed by the largest independent broker-dealer in the country. You can feel safe knowing our advisors have all the knowledge and tools to guide you to your goals. Flagship Wealth Management, helping you navigate your way to financial freedom.
Well, Dave, we're sitting in a nice pair of seats right now, but why don't we say we turn the temperature up and say that these are the hot seats? What do you think?
I'm ready to go.
All right, this is the part of the program where we take your questions from the viewer, and if we answer them on the air, Dave, we'll give you some tickets to an event courtesy of Live Nation. By the way, for the hottest seat in town, visit livenation.com. What do you say we crank out some answers here to these questions?
Question number one.
All right, I often hear people talk about timing the market. What exactly does that mean? That comes from Wendy in Hull.
I think it's a common investor misconception where they believe that, you know, everybody out there should be able to know exactly when to buy and when to sell. The bottom line is, especially with this market being overheated, meaning we think it's overextended, instead of trying to time it and get in one day versus another day, it's important to maybe you do what's called dollar cost averaging, where you decide each and every month on the same day to put a certain amount of money in, okay? And what you'll do is you'll offset, you'll buy some high, but you'll also buy some low and eliminate some of the volatility. Don't try to time the market. The market makes people look silly for those that do.
And of course, if people really could do that, they'd be sitting on a yacht in Tahiti.
Yeah, we wouldn't have jobs. You know, even experts can be wrong. Even these experts can be wrong. So again, it's important to dollar cost average, especially in this market.
All right, Maria in Melrose wants to know, she has paid down her credit cards, but she still has a large balance. I have recently come into some extra money. Should I pay off credit card debt first or apply this cash towards my home equity line? People ask this all the time.
Yeah, you hear it all the time too. You pay off that high credit card debt, you're giving yourself a guaranteed rate of return. And with the home equity lines down, you know, at 2.5% to 3% with a tax deduction, it makes sense that you pay those high credit cards off first, then look at the equity line. But with that tax deduction and everything else, once you pay the credit cards down and you cut them up, it may make some sense to start investing that elsewhere.
I see in my crystal ball that we need to do a whole show on credit cards down the road, because that's a thing that most people get themselves into financial trouble with.
Yeah, it's easy. It's easy to go out there and charge it to your room when you're on vacation.
Absolutely.
You pay the price when you get home.
All right, Brian in Bridgeport, Connecticut. I have recently retired and I'm looking for a financial advisor. I don't know where to start. How do I research a financial advisor's background?
Brian, you started at the right place. You're checking into Money Matters, right? But in all seriousness, it's important to check out the person's background. You know, you'd be amazed how many people check on, you know, the people working on the roof with a Better Business Bureau, but don't check the person that's investing their retirement dollars. My suggestion to you is to go what's called Broker Check or FINRA, FINRA.com. Input the name of the person that you're doing business with or interviewing, see what type of licenses they have, see whether or not they've got any complaints. And obviously, ask to see a list of clients. You know, ask to see, you know, how has that relationship worked for you? I think those are two good places to start.
And a third would be the wall at the post office. If you see their picture up there, you want to steer clear, right? Wouldn't that be a good piece of advice?
Always. I'm trying to be serious with Brian. That's a place to avoid.
So, Dave, when we came up for the idea of Money Matters Boston TV, you'd have to say that this program specifically was just what we were looking to do.
Yeah, the momentum is really starting to build, Chuck. We're really starting to get some powerful, knowledgeable money managers and experts on the show.
Well, we want to thank the UMass Club for hosting us here today in the Presidential Parlor. And of course, if you want to see us each and every week, tune in to New England Cable News every Saturday at 11:30. We'll be here next week. Big smiles on our faces. And if you just want the radio end of it, well, we're on 96.9 Boston Talks every Sunday at noon if you can't get enough of Dave McDonough and myself. There's so many people out there that they can't get enough, Dave.
I guarantee it, Chuck.
Absolutely. Well, we'll see y'all next week. Have a great one, folks. Be safe. And next Saturday at 11:30, join us for more Money Matters Boston.